Meta stock, guys, this video, we're going to go look at Meta stock. It was up 11.5% in April. In the last 1 year, it's up 12.5%. Since November 4th of 2022, a mere 5-6 months ago, Mo's laughing, it was at $88 a share. What's it at today?
$237.25.
And it's down $3, so it was at 240. All right, guys, if you're interested in learning about options and how you can use options to make extra income and extra small returns on your money, we have a free webinar on Thursday, 6 p.m. Eastern time. Sign up the link below. It's absolutely free. Sign up. You can learn how to use options. Even if you don't have enough shares, learn it now so that when you do, you can make extra income on your investments. Sign up now, the link below. So let's take a look at Meta. Let's take a look at it, decide what we're going to pay for it at the end with our stock analyzer tool. So let's check this out. So first off, market cap, $621 billion, okay? Enterprise value, $644. Okay, now the difference for those of you who are new to the channel, this difference is essentially the net debt on the company. Debt against cash, etc. So they have very little debt in the company relative to their market cap. Revenue in the last 12 months, $117 billion, profit of 21. Now, their current PE is 29, which is pretty high, right? Overall, their 5-year PE is 23. So this tells me, okay, they've made less money in the last year than over the last 5 years relative to value. Look at this gross margin, Mo. 78%. Yeah, that means for every extra dollar they bring in, 78 cents of that can go towards paying overhead and income taxes. That's incredible. As an example, Microsoft's 68%. Amazon's like 13%. Tesla is like down to like 12% now. Yeah. It was at 18, 19. So no dividends, understandable. And here's their 5-year average free cash flow of $24 billion and last year of $17.5 billion. Now, why is their free cash flow down? The metaverse they're investing in. But look at this return on invested capital over the last 5 years, Mo. 16%.
Yeah, I like that.
So guys, what does that mean? What this means is they get a high return on the money that's invested in the business. This can show a strong moat, which allows them to maintain their profitability. And when they do find areas they can invest in, they get a high return on that money. Mm-hmm. You should pay a premium for companies that have a high return on invested capital. If you watch our videos from 2 or 3 years ago versus today, I focus on this a lot more. And my multiples have gotten higher. This is something I definitely changed in my investment. When I started seeing so many value investors focus on this return on invested capital, I went and learned this. I knew about it before, but I didn't understand how it really helped. And I thought it was a mathematical equation. This is, but the premium you pay, that's the art.
Yeah.
Right, Mo?
Yeah, it really drives business over a long period of time.
Right. Well, and the moat.
Mm-hmm. Of course. Yeah, the return on invested capital is arguably higher in moats.
And if you look at Joel Greenblatt, who wrote the little book that beats the market, he looks at return on assets, which is similar to return on invested capital. And he says that's basically your moat.
Yeah.
That's how you find a moat. Is it a higher? Look at Apple, 37% 5-year return on invested capital.
That's huge.
Microsoft's in the mid-20s. The market overall is 9 or 10%.
Yeah.
So that's a huge number. Even 16% is very high. All right.
Speaking of moats.
Yeah.
Look at this real quick. Daily active users, 2.04 billion as of March of 2023, a 4% increase year over year. Monthly active users, 2.99 billion, an increase of 2% year over year.
Guys, they have so many people. You're not going to expect to get 20% growth in that number. That's to me, even seeing growth is awesome.
Right. I think that an increase of 4% and 2% respectively is huge.
Yeah, that's a big number.
Huge.
Guys, they have Instagram, they have WhatsApp, they have Facebook.
They haven't even been monetizing WhatsApp yet.
I know, and WhatsApp is incredible. Guys, literally, the only people in the world that don't use WhatsApp for their main
Americans.
is Americans.
Yeah.
I just came in from the Caribbean, and literally it was, they ask you, what's your WhatsApp? They didn't ask you, what's your phone number? Because your phone number is your WhatsApp number. Right. They say, what's your WhatsApp?
Yeah.
Right?
That's
so
amazing.
The only people we talk to on WhatsApp are friends who have Androids.
Yeah.
Poor guy.
Yeah.
He's too cheap.
Let's not get into it.
Yeah. All right, let's check out the 8 pillars on Meta. All right, so Meta has a little bit higher of the 8 pillars here. Now, guys, remember, if you have our software, you can go edit your pillars right here and make a combination up to 12 pillars. You don't have to stick to the 8. I stick to my pillars here because that's basically why we created it. However, Mo, which I like what he did, he changed his 5-year ROIC to higher numbers. I don't blame him for that. I just use it as kind of like a minimum for me of 9%. Yep. All right, so Mo does a higher one, and I don't blame him. I actually think it's smart. All right, so this is basically just saying to us, guys, we like everything here. It's just the valuation. Yeah. And by the way, you should pay a premium for the high return on invested capital. So this may be fine.
Yeah, absolutely.
This valuation may be fine. As an example, if I showed you two companies that are exactly the same, one has a 30% return on invested capital, one has a 5%, which one should you pay more for?
30%.
Absolutely. Just like growth. If you saw two companies, because Meta is going to have some growth issues. They're not going to grow at 20% a year, but they can really drive down with this high gross margin here, 78%. As they do increase their revenue, a lot more money will be going to the bottom line, right? Yep. That's the thing you have to remember here. That's the thing you have to remember. This high gross margin can really add a lot of extra money to the bottom line because they don't need to spend more on overhead to get to increase their revenue 10%.
Right.
I bet you their overhead doesn't have to go up at all. And they're actually cutting their overhead now.
Yeah.
They were the leaders of, they're like, hey, we're going to cut jobs.
This is the year of efficiency, according to Zuckerberg.
Yeah, the year of efficiency. He said, we overhired during COVID.
Yeah.
We thought it was going to be a much better few years, and it wasn't. That's what he said. Okay?
A lot of tech companies did.
So on our software, let's see what analyst estimates are. This boring company, according to analysts, is going to grow their profit 80% over the next 4 or 5 years. That's what you're seeing from the fact, because look at their revenue growth. Not as big. It's not 80%. It's roughly 40%. That's why you have a high gross margin. A lower revenue growth number still drives a lot to the bottom line. Yeah. Now keep in mind, these are still analysts. And what do we think of analysts, Mo?
Take them with a grain of salt.
Correct. But it's a nice way to kind of sit there and say, what's the market looking at? Yeah. Okay? I don't really, I always look at analysts to say, are they expecting something worse than, because if they're being negative, I'm like, okay, I got to wonder what's going on there.
They're the cheerleaders.
All right, Mo, so what are some of the bull and bear cases for Meta?
So I like this one. They bought back 56 million shares, 9.2 billion, at an average price of $164.
Oh, see, that's good.
Finally getting a company that's buying back shares at the right time.
So remember, guys, when it comes to buying back shares, everybody gets excited about it. But if they're buying overpriced shares back, that is not good for you as an investor. Mm-hmm. You want them buying underpriced shares back. And I'm sure some of those sales were in the 100 or below level.
Oh, yeah.
Which is incredible.
For sure.
All right, what's another bull case?
26% more ads were delivered year over year.
Wow.
That's a huge number.
But I will say this. The other day, I was lying in bed, Lisa's scrolling, and she goes, God, there's so many ads on Facebook.
So we're getting back to that point. Because I remember people were saying that almost prior to the pandemic.
Yeah, but Instagram, we don't see that. I don't feel like I'm inundated on Instagram. Probably because it's a younger market there.
Yeah. Now, another good one. The shorts.
Yeah.
They're supposed to contribute to top line this year.
Oh, great.
So that's good.
So they weren't charging ads before. They weren't charging money before, but now they are.
Exactly.
Great.
Exactly. Now let's do some bears. This is one that I don't really think is much of a bear case. Reality Labs operated at a loss.
Well, yeah, it's going to operate at a loss for a long time.
Yeah.
But it was a bigger loss.
It was a bigger loss, but they can afford it.
And if they choose to stop it suddenly, all of a sudden the company's flush with more cash flow.
Yeah. Yeah.
The revenue was down too on the Reality Labs.
This is people are talking about this one a lot. Irish Data Protection Commission fined Meta and is looking at to change personal advertising laws in the EU. I get it.
That would directly affect.
It would trickle. I think that would probably trickle to the United States.
Do you think
in
so?
Some fashion. Yeah. I mean, but I don't know. Those are the bear cases.
So the average, I think it's something like $45 is the average revenue per user in the States, but internationally it's like $5. Oh, wow. So major bull case for me is the major upside potential internationally as the world gets wealthier and wealthier. Mm-hmm. Imagine 20 years from now, that gap is going to go from 10 to 1 to 5 to 1 or something like that. And that's going to really make Meta, as long as they're able to keep their hold on people's users, a much more valuable company in the future.
Yeah, for sure.
So what do you do with all this information? Well, we use our stock analyzer tool. Now, this was the biggest part of our site last year, 1.3 million uses of it. So if you like this and you'd like what you've seen so far, I strongly encourage you to go to everythingmoney.com. Every month, the cost goes up. So when you sign up now, you're locking yourself in for a little over $1 a day. You get all this software, plus all these tools we didn't even go over, and this community of thousands of investors you can talk to. Because guys, I'm lazy about research. That's why I like going to the community. I can go search a specific company and see what people are saying. I can ask my own questions and people out there will find the answers, or who know the answers will put it in there. This is a no-brainer, a little over $1 a day. Everythingmoney.com, go sign up now. So Mo,
yes,
you're gonna do a 10-year analysis.
Yes.
I'm gonna do 20-year analysis.
Okay.
We're going to sit here. We're going to put our assumptions in for all of these parameters here: revenue growth, profit margin, free cash flow margin. Do our assumptions for a multiple at the end, and it'll tell us what price, if what price we need to pay in order to get those returns. So hang on just 1 second. Okay, guys, again, I'm doing a 20-year analysis. Mo's doing a 10-year. And I want you guys to know something. If you go back and look at our other videos on Meta, we're going to come up with different numbers. Just like Warren Buffett and Charlie Munger say, if they talk to each other any given day, they're going to come up with different numbers as a value for Berkshire Hathaway. The goal here is to say, is it obviously a buy? Is it not obviously a buy? Right? Yep. That's when you should be pulling the trigger. So let's go through. Mo, what did you do on your 10-year analysis for revenue growth?
So I did 5, 9, and 13.
Love it.
Yep.
I did 3, 6, and 9. Because remember, I'm going out 20 years.
Right.
And I want to be a little conservative.
Right.
Profit margin.
25, 28, and 31.
So I did 22,
okay,
28, and 34.
Okay.
Let's say the metaverse works out. Let's say they really drive revenue. Could they do it? Sure, they could do that. Are they going to? I don't know.
Yeah.
Free cash flow margin, I did the exact same thing.
Yeah, I did the same thing, 25, 28, 31.
Okay. PE.
I did 15, 17, and 19.
I did 15, 16 and a half, and 18. Okay. Same with my free cash flow.
Yep, same with my free cash flow.
And your desired return?
10, 12, and 14.
That's what I did.
Yeah.
So guys, as I made my assumptions higher, I put in more margin of error, more margin of safety. That's the higher desired return. Remember, the higher return, the lower you have to pay for the investment, right?
Yep.
Think about that. Make sure you understand that, because that's really important. This is essentially your margin of safety. You don't need to go take the numbers below and then discount it even further.
Right.
So the stock is currently at 237. I hit the analyze button. Now look at this. Now it's all of a sudden mostly red.
Yeah.
Before it was mostly green.
Right.
147 is the low, 311 is the high, 220 in the middle. Mo, what do you have?
I have 194 is the low, 377 is the high, 275 is the middle.
And again, different time frames we're looking at. Mo's looking at 10 years, I'm looking at 20, but very different numbers. The bottom line is, it's not an obvious buy to me.
No, not anymore.
So I just got to be patient.
Yep.
But go look at our past videos. When it was at $90 a share, it was all green. Mm-hmm. Thank you very much, guys. Appreciate it. Again, everythingmoney.com. And don't forget to sign up for our webinar below this Thursday on options. It's for free.